All right, everyone. Late night, Manny Mula. Let's get into this. I recorded this the other day and went to go edit it, and there was no sound. So hopefully, take two does a little bit better. Today, we're going to talk about Cardone Capital. I invested in. It's when I moved to Trinidad for the year, so I think it was like the May June 2019 timeframe. So now at this point, I have about 4 or 5 years under our belt, and I just want to walk into what we're actually looking at and what we're actually getting in terms of appreciation a little bit, and also the monthly income that we're getting from it. Both of which is very important to kind of understand. A lot of people are somewhat confused. I actually own part of these five apartment complexes we're going to be talking through today. It's not a loan out to grant or anything like that. I'm a partner within these five apartment complexes, so I own percentages of them. I forget how much on my K1. It's like a very small percentage, but either way, as these appreciate, my ownership and the value of my ownership appreciates with it. And it's actually doubled, or if not, gone a little bit more than that, just based off of recent appraisals over the past few years. So for those of you other folks that are looking at this, you're also investing in Cardone Capital. Cardone Capital Equity Fund 5. So very early on, it's the non-accredited, one of the first non-accredited that Grant Cardone had done. At the time, I just wasn't up to speed yet. I didn't have $1 million, and I didn't pass the $200,000 per year threshold. So I was kind of shit out of luck. So I was very fortunate that Grant was able to offer something like this. I know he got a lot of slack from other people. They didn't fully understand. It's pretty non-liquid, and what I mean by that is like real estate, you can't just whimsically buy in, buy and sell out within a month's time frame. If you want to do something like that, invest in a real estate investment trust. This is actually physical real estate ownership in 4 or 5 properties that we'll go through today, and you get a little bit of a drip from that. I think it started off. I put in $15,000. I was getting about $50 a month. To you, that might not seem like a lot, but that's like $600 a year. And now it's slightly increased. It's like $65 a month. So it's about 5% on that 15,000. So $65 or whatever ends up being like $750. That ends up being about 5%, 5.2% annually just on that. And then while you are getting that monthly drip, you still own the properties. So if the valuation of the property goes up 2, 3, 4x, you have to think you're not fully buying these properties, right? So the amount of money that you're getting is kind of leveraged. So if these properties go up by double, you're getting a crap ton of money because you might have only put down 30, 40% for some of these properties. And if the value of them goes up substantially, your equity goes up pretty substantially. So with that said, I've made a pretty good chunk of change just from the appreciation of that. But I won't go into that because there's a bunch of tax forms, K1s, etc. And with that, you end up having a crap ton of different stuff that you need to kind of go through. And it's just going to be a lot to block out. So what I can share is quickly this. You can see, the last 5 years, all the income I've kind of made: $650 in 2020, $600 in 2021, $671 in 22, $750 last year, and we just started this year. So overall, I've made about $3,000. So returned of about 20% in terms of actual distributions directly to my bank account. And then the actual still ownership of these 5 properties that you're seeing on the screen here, 2 of which are in Miami. One is in Naples, Florida. One is in Panama City Beach. And then one here is directly southwest of where I live here in Houston. And so you have 5 assets within here that are generating cash flow, and I own a percentage of, which is kind of badass. And what actually got me enticed was when I was moving back from Trinidad, went to actually go visit this property, and it was actually something I'd done some research on prior to leaving, and noticed like, oh shit, this property is going to be like legit and out there, and I wanted to get involved. So I was like, if I have an opportunity, 15 grand, what's the worst that happens? It goes to zero. And here I am sitting, getting a little bit of a drip every month and owning part of these 5 apartment buildings. So let's hop into this. I've shared a few of these in the past, and Grant hasn't taken down any of my videos or sued me yet, and I don't expect them to, because I always generally talk pretty positively about this experience, and I hope I get to a place where I can do a little bit more with it. But specifically for Cardone Equity Fund 5, invested in 5 quality assets totaling about 2,000 units located across Florida, Texas. You have Del Rey, Riverstone, Sawgrass, Naples, and Breakfast Point. And the majority of the portfolio properties increased revenues, net operating incomes year over year for the third quarter of this year. And occupancy averaged just under 95% for the portfolio, contributed an annualized 5% cash on cash return for Q3. And yeah, we'll get into specifically what else is going on. So then it kind of breaks down. If you haven't watched any of these videos before, it shows like the 5 different properties, and it kind of compares last year's performance versus this year's performance. And there's also the year to date for 2022 versus the year to date for 2023. And so we go into a little bit about it. And what I want to kind of like take a 5,000 foot view before we dive into this is like, I don't think the intent is to fully hold these things forever. I think the opportunity and the intent is make a little bit of money from these and then refinance them when appropriate. So you'll see throughout here, the second half of the 2020s, a lot of these properties, they mature. And what that means is like there's a balloon payment or you have to refinance them. And so I fully expect that either part or some of these will be refinanced within the next 4 to 5 years. And I think that's a good opportunity, one, for me to get a little bit of cash flow. I can decide to use that for my own personal investment properties or have the opportunity to reinvest into other properties that Cardone is kind of offering. And then two, if I wanted to, I could just put this in the S&P or something like that. So it gives me that opportunity. I would love to keep seeing what happens with this because this is a rather small portion of my portfolio. It's less than, I guess, really, it's a little bit over 1%. So it's very small. But I'd love to keep kind of seeing where this leads to and really get after it. So that being said, some of these are interest-only payments for the first 5 years. Some of them are principal and interest, but all of them are generally maturing within the next 5 years. So I'm curious to see what happens when we refinance, and I'll keep you guys apprised of that when that happens. So going a little bit and scrolling and zooming in here, highlights of Q3. Most of this is either just the highlights of this quarter or year over year information, so keep that in mind. 95% occupancy, 96% leased. New leases came in Q3. Effective net rent increases of 6% over prior leases, which is pretty good. Strong rent growth, revenue and net operating income this quarter increased by 6% and 1% respectively, comparatively to last year's levels. Cash flow decreased slightly due to increased CapEx. So let's just take a quick look. So you see for year to date, we went up from about 6.6 million year to date in terms of total revenue to about 7.2. So $600,000 increase there overall for the first three quarters of the year. So that means NOI increased just under 250 grand. That's a good deal. Debt stayed the same. Capital improvements pretty much doubled. So there's something to be said about that. And then cash flow went from about just under 2 million to just under 2.1 million. So pretty good with that. An increase of about 100,000, which makes sense because net operating income went up by about 250. You increase the capital spend by about 150. So it makes about sense that, your cash flow is where it is. So good things associated with that to kind of come, hopefully. The bulk of the capital improvements that they're stating is unit-related expenses with respect to flooring, HVAC, appliances, etc. And so I think it's just modernization of some of these. So at the moment, they just say best to hold the unit, an asset as the best economic path for the projects, and they'll continue to see what happens if it continues to perform well. So that was Del Rey. That's 350 units there. You have Stella at Riverstone, which is southwest of Houston here. This is maturing in 2029 timeframe, 10 years, interest only, 4.3%. So this is a good boy to hold for quite some time. 350 units once again. And they purchased this in 2019 timeframe. So 95% occupied, 97% leased for third quarter 2023. And they increased net effective rents by 3% over last year. What else is there? Strong rent growth and year-to-date net operating income increased by 5%, 12% respectively. So we'll take a look at that in a second. And once again, fence painting and HVAC and flooring, etc., is what the CapEx really is for that. And there's not a lot of CapEx spend for Stella. But you can see slight increases, about $200,000 for revenue, which leads to about $150,000 in net operating income. Debt stays flat. Capital improvements is about flat for the first 3 quarters of the year. And so net operating income ends up about $180,000 more, which is pretty good. And they hold the asset. Currently, it seems to be performing well. I would agree. I think it's a good environment to hold. And as interest rates come down, I think the value of these things will continue to go up. So what else do we got here? So we have Sawgrass. This is 500 units, a big boy. So you can see we're $10 million a year in rental income. And this is for the third quarter, right? So we're going to probably close in at $13, $14 million for the year. So this is a big boy. So 93% occupied, decrease in occupancy compared to 2022. Maintained occupancy at or above average for the comp set in the area. Highest net effective rent per square foot in the area, which is bueno, right? So new leases and renewals are commencing in Q3 have an average net effective rent increase of 4% over prior rents, driven by strong rent growth. Net operating income, cash flow this quarter increased by 8% and 16% respectively. That's huge. And bulk of capital improvements is pretty small, so it's actually decreased by 50% year to date in comparison. So let's take a quick look. What changed for this bad boy? So about $1 million increase in total revenues for the first three quarters. So that leads to a pretty substantial increase in net operating income, going from about 5.7 to 6.15. So big jump there. Debt service stays the same, $2.5 million. Capital improvements is down by 50%, but still really small. And then cash flow went from just under $3 million to almost $3.5 million. So this thing might close in on $5 million in cash flow. This is a monster. And if you think about that, it's about 33%, so about a third of the revenues coming in as cash flow versus about 31% last year. So hopefully that continues in that direction, because that's a monster comparatively to like where we're at with some of these other properties. So like Stella was at 28% last year for the first three quarters, and it's at 30 this year. And then for Del Rey, for Del Rey, it's at 30%, and actually went down a little bit. And I think a lot of that has to do with the capital expenditures increasing a little bit. But overall, looking pretty bueno for those first three opportunities there. Then you have Naples. This is about 450 units here. This is also a big boy. Interest payments for the first 6 years. So let's just go through it. Big increase in revenue for the first three quarters. $6.8 million to $8 million. So about $1.2 million increase. So what happened? 97% occupancy, which is pretty good. 3 percentage points increase year over year. New leases coming in about 3% over prior rents. So more rent, higher rent value. More tenants, higher rent value. And then rent growth, net operating income, cash flow increased by 12%, 17% respectively. Huge. And then capital improvements, which is up about 100,000. So it's increased by about 30% but it's still on a relatively small number. So if you look, net operating income went from about $4.5 million to 5.3. I was going to say 5.4, but debt stayed the same, 2.1 million, about 30%, but decreased overall to about a quarter with this one, because obviously the revenues have gone up so much. Cash flow went from 32% to 35%. So muy bueno there. And I guess it's just things are looking up with this one. A lot of spending in CapEx for this quarter, though. So hopefully that gets kind of subsided. It's about $200,000 in CapEx, which is about half of what's been spent year to date. So hopefully as you go to the fourth quarter, it kind of settles down. So this one looked pretty good as well. Determined to hold it, best economic value for the asset at the moment. This one is 3.25%, 5-year only. So it's going to mature here in 2029. So this one, 5 years interest only, though. The payments are going to balloon here in 2024. So keep that in mind in terms of it going to principal and interest. So curious to see what happens with that. But so far, 4% year over year rent increases, 1% over 2023 for net operating income remained rather flat. Cash flow increased 15%, decreased capital. So what happened? About $150,000 of revenue increase. Net operating income up about 30,000 or so. Debt service is the same. Capital improvements is down by about 100,000. Cash flow up. It was about 30% last year for the first 3 quarters, about 31% this year for the past 3 quarters. So holding for now. But if you look at it, man, like these things are pretty good. I think the only thing that I'm concerned about is some of these things within the next, few years are, for example, I'm curious to see what happens with Del Rey in this upcoming quarter, because it goes off of interest only in the fourth quarter. These are the third quarter payments, right, for 2023. So in the fourth quarter, this is actually going to show up. So I'm curious to see how the payments go down, and I'm going to watch this for the first few quarters of next year to see how things are looking, right? Are you still making enough money to cash flow? And my thought process is yes, because you don't pay a lot of principal early on anyway. So curious to see what ends up happening with that. And then same thing with this last property here at Breakfast Point, 360 unit boy, but 5-year interest only, and this goes to pretty much the third quarter of 2024. So coming in fourth quarter of this year, this one's going to go and be interest and principal, and so that'll impact your net operating income for this property as well. But if you think about it, relatively good from a opportunity of owning real estate, A-class sort of real estate in a great building area in Florida. You've heard of those places before. It's not anything too crazy, and so really curious to see how they continue to do. I'll keep everyone apprised of it, but I think the big thing that I always see and hear on a lot of these videos and comment section is like, "Ha, you're an idiot. You've only made $3,000." It's like, yeah, but I have $3,000 plus ownership of those properties still. Like, it's like as if I were to rent out this house that I'm living in. Okay, I only made $3,000, but I still own the house, right? And I still own the appreciation on the house and everything associated with it. So I'm in the positive here. Yes, I've made 20% in terms of returns physically to my bank account, physical cash over the past 4 or 5 years. I guess 4 years, 4.5 years. And so with that, I can do whatever I want, pay bills, use it to reinvest in other things like real estate investment trust, S&P 500. But I'm still getting that cash flow, right? It's not like I'm done at 20%. I still get that 5% a year for the time being, unless there's another pandemic or something like that. And then also, I still own, if they were to sell the buildings for, 30%, 40% more than what we bought them for, I get the difference of that, right? So I own a percentage of it. I don't know what it is. It's like 0.2% or something like that of these buildings, something very small. But if that grows, I get a huge chunk of that. So if you think about it, if you put 10% down on a building, let's just say you put 20% down on a building and it goes up 100%, well, you not only get your 20% back, but you also get that other 100% that it went up because you control that building, right? So you're levered 5 to 1 if you put down 20%. Now, if you put down 33%, you're levered 3 to 1, etc. But that's kind of the thought process is it's like you don't need this thing to go up, 10, 20, 30 X, right? You just need it to go up 1, 2, 3%, or sorry, 1, 2, 3 times, and you're going to get huge multiples on your money because you control the entirety of the asset, but you only put down, say, 20%, 30%. And that's the benefit of real estate. Even if it goes up, let's just say at the rate of inflation, 2%, 3% per annum in terms of the value of the place. Let's just say you start at a $100,000 home and you put down 20%. So you put down your $20,000 and the home goes up by 102,000 or by 2% inflation, 2%. Now the value of the home is 102% or $102,000, I mean. So with that, what does that mean on your money? Well, you put down $20,000. So is it only up 2% on your money? No, it's actually up 10% on your money because you're leveraged 5 to 1. So you get to keep that. Yes, there's fees associated with sales and etc., but you get the point, right? You can lever up very well with real estate in a very safe manner. And these are great properties, 350 units up to 500 units. People are going to rent these out. And it's Florida, so a lot of people are migrating to Florida because of the rules and regulations and the laws and the way that lifestyle is down in Florida. So a lot of people are exodusing to from where they're at to Florida because of the laws and everything that's going on. Great business, regulatory environment is favorable for businesses there. So anyway, just wanted to share that with folks. I know that people like to hate on Grant. I think it's easy to poke at him because he's boisterous and is able to really get under people's skin. But I think he set up a pretty good opportunity for people. I'd say check it out. I think it's a good opportunity to diversify personally. I think it's something I'll probably keep some of my money in because one, yeah, you can do some of that real estate piece on your own, but it's going to require you to do some work. Like I do the Airbnb thing as well, and I get messages all the time, and I like it. It's not a bad thing, but this other piece is kind of set it and forget it. I think about it once a quarter when I get the numbers, right? And with that, it's pretty simple. I just look at the numbers, make sure everything's coming in. Maybe I look at it once a month when I get my paycheck on the 15th. But other than that, I know it's going to be coming in. And Grant does a really good job keeping people apprised on a monthly basis for investor calls too. So food for thought. I'm curious to hear what people say. This video generally goes outside of the subscriber base by a pretty significant margin because it's attached to Cardone Capital. So really curious what people's thoughts are. Hopefully this video was helpful for you. 21 minutes or so of opportunity to hear questions and stuff like that. Other than that, have a good one, and curious to follow up at the end of the year because we should be getting the next report here in February timeframe where I can do a full year 2024 analysis, and curious to see what the valuations are for the businesses this year. Last year or the year before, it was up over 100%. It was over $30,000 that the value of what I have is valued at. So at this point, I've gotten my 20% cash directly to me on a monthly basis, the $65 or whatever it is, and it grows every single year, or it has been for the last few years. And I still have the opportunity for when they cash out or refinance the properties or sell the properties to get double my money back, if not more. So, so far so good. And if anything bad happens or anything good happens, I'll keep you guys apprised of that. So talk to you guys soon. Hope this was helpful.